Hey everyone, welcome back to my channel. My name is Muhammad Zishan and I am a qualified accountant and I'm doing tax planning for past 5-6 years. So in this video, we are going to talk about the most talked topic in the UK tax, which is the election of remittance basis for non-doms. And yes, we are even going to take a closer look into Akshata Murty case, who is wife of ex-Prime Minister Rishi Sunak. She has reportedly saved over 20 million pounds in taxes in the UK by using very same rule. So let's get dive in. If you're living in the UK but have your permanent home or domicile in another country, you are considered a non-domicile, non-dom individual. Non-doms who are UK tax residents have two options when it comes to paying tax on the overseas income and gains. They can be taxed on the arising basis, which means paying UK taxes on worldwide income, or they can choose the remittance basis, where they only pay UK tax if they actually bring that income into the UK. That small but powerful exemption. If your unremitted overseas gains are below £2,000, you don't need to claim remittance basis. Even you don't need to report that into your UK tax return. But once you cross that threshold of £2,000, things get interesting and more complex. Now, let's talk about remittance basis, a choice that can be a tax efficient strategy, but it comes with some caveats. There are few positive points. Number one is you are only taxed on income you bring into the UK. And number two is offshore income left abroad is not taxed in the UK. And there are some negative points, which are you lose your personal allowance and your capital gain tax exemption, which are £12,570 and £3,000 respectively. Any overseas interest or dividends brought into the UK are taxed as non-saving income. And there's a remittance basis charge £30,000 if you have been UK resident for 7 of the last 9 tax years, £60,000 if resident for 12 of the last 14 tax years. So yes, it's beneficial, but it's not a free. Now, let's break it down with Akshata Murty example. She is a domiciled in India and has been a UK tax resident for 7 years, and she is an additional taxpayer. Let's say she has unremitted and overseas dividend of £1 million. If she is taxed under the arising basis, she pays UK income tax on that £1 million. Here's how it looks like. £1 million minus £500 dividend allowance is equal to 99500. Tax at 39.35% is equal to 393303. But if she's claimed the remittance basis and keeps that money offshore, she does not pay any UK tax on it. Yes, she loses her CGT exemption of £3,000 and has no personal allowance, but she would not get that anyway as an additional rate taxpayer. So for her, the only cost is £30,000 remittance basis charge, but she is still saving 300, and then £3,303 minus £30,000 is equal to £303,000 303 in tax savings. And now it's just for 1 year. And if you add this up over the several years, you will start seeing how reportedly £20 million tax savings added up over the years. I hope now you have understood what the remittance basis is and how does it work. Let's quickly wrap it up with a few key takeaways. Number one is if you are a UK resident with a non-dom status, you must understand your tax position. Secondly, remittance basis gives a huge tax saving. However, it only gives you a tax savings when you use it correctly. And finally, make sure you should take a tailored advice, especially when you are approaching to your 7th year or your 12th year in the UK. If this video helped you to understand remittance basis, please give a thumbs up, like and subscribe, and do not forget to share it with your friends and family. So until the next time, please keep learning and keep exploring, and do not try to leave a comment if you have any questions. As always, hand ahead salute. Until the next video.